Hello, Ruby Chouhan. How are you today?
Hi, Paul. I'm wonderful. How are you?
I am so excited to have you. So, give the nomads, the expats, a bit of a two-liner on exactly what you do and how you can help them.
Absolutely. So I help Canadians all over the world, from Uganda to Australia to Dubai to UK, etc. I'm a global real estate and tax advisor, and essentially I'm co-founder and VP of an international tax firm. We're a boutique tax firm that helps Canadian expats and non-residents across the globe. And I'm also a real estate broker here in the Greater Toronto area.
I love it.
That's
The
what I
the
do.
one-stop shop for the nomads and expats. So look, I have a lot of friends living in New York, living in Europe now. We are in a super remote world. Lots of even big companies like Amazon have a remote mandate. You don't have to come to the office. So given that there's also inflation in places like Argentina and like our dollar is going further in other spots, why not just pack up and roll somewhere else as a current resident? So I guess like as people start to let me make that move, I mean, my first question is, at what point, and I'm sure it's not black and white, would I have to start to declare I'm a non-resident? Like, as I traveled a lot last year, and I was gone for about 4 months, but I didn't really have to do any of that. So, is there a general threshold where, like, okay, like the government's like, you're no longer really here, and you're probably paying taxes somewhere else, so we're gonna not tax you. Like, how does that work?
High level, it's very dependent on each individual circumstances and facts. Like you said, in today's day and age, people are living in multiple countries, having employment in multiple countries, owning properties in multiple countries, and it can be really difficult to determine if you're a tax resident of Canada or a tax resident of another country. So, generally speaking, there's primary ties and secondary ties. For example, where your home is, where your family is, where you're in employment, um, that can determine your tax residency status and also days that you can spend in Canada. But one, like for example, the number of days you spend in Canada doesn't make or break your tax residency status. You owning a property in Canada doesn't make or break your
Hmm.
tax residency status. So it's really important you speak to an accounting professional who specializes in non-resident tax, because
Mhm.
also, most Canadian accounting firms, they don't really deal with the non-resident tax matters. There's
Hmm.
different divisions at the CRA, and they never end up dealing with disclosures when it comes to, let's say, departing from Canada as a tax resident or different tax withholdings that need to happen as a non-resident. So each person's situation needs to be looked at individually. And adding to that, sometimes people they submit something called an NR73 questionnaire with the CRA. Pretty much it's a long, over 100 questions questionnaire that asks the CRA's opinion based on how you fill out the form, but that could be incorrect too, depending on how you fill out the form. And it takes over a year and a half to get an opinion. So it's really important you speak to a professional about your specific situation just to make sure, when did you exactly become a non-resident for tax purposes? What are the next steps to cease your tax residency status with the CRA? What tax filings are required?
Hmm.
And if you are a non-resident and you do still have some sort of Canadian income, like pension income or rental income, what needs to be done with regards to that Canadian income that you're
Right.
still earning?
And I
Yeah,
presume like I would want to be a non-resident if I'm already paying taxes somewhere else. That's like people become non-residents to not be double taxed, I assume.
exactly.
Right.
That's
Okay.
exactly it. The Canadian dream now really is to own assets in Canada, which grow and then move outside of Canada, so they're not paying Canadian taxes, because our tax rates are very, very high compared to other
Mm-hmm.
countries.
Mm-hmm.
And there's actually other countries that have zero tax or very minimal
Right.
tax.
Of course.
And to add to that, there's tax treaties and tax conventions in other countries, meaning those tax treaties are in place to prevent double taxation. So you're really only paying tax to one country versus the other.
Yeah, that's exciting just as you say that. I'm like, oh wow, like the world really is your oyster. Look, a lot of Canadians are moving abroad right now, and maybe you're seeing a trend on why that is. And a lot of those people actually have real estate. I mean, definitely many of our clients. So what are some of the, I mean, let's call it surprises they may want to avoid or the due diligence checklist they should think about as they're moving abroad, and especially if they own real estate?
Absolutely. I would say there's a few main items. For example, often people, when they leave Canada, they don't want to let go of their Canadian real estate that they already own.
Totally. Of
It's a large investment. It can turn into a rental property.
course, yeah.
And in future, maybe they can refinance and grow their real estate portfolio. So when someone leaves Canada, they are required to disclose their property values in case there's a capital gain. And failing to disclose that results in penalties too. There's a specific form that needs to be filed. Then let's imagine that it was your principal residence, meaning that capital gains was exempt, because here in Canada, if you live in a property as your principal residence, you have a principal residence exemption when you sell the property. So you don't have to pay tax on any gain that the property has earned in value over the years, right? However, when you convert your principal residence to a rental property, there's actually different forms and elections that can be filed to help defer capital gains
Mm.
for a few extra years. So that can be a cost savings at the end of the day when you sell. And then also, if you have rental property, there's tax withholding and filing requirements related to the rental income as well that come into play right when you become a non-resident and start earning rental income.
Hmm.
Yeah.
So given that, obviously they should consult with someone like you to, again, is the key word defer, or are there ways where they just won't be taxed as much?
There's multiple different things related to the principal residence converting to a rental property. Then separately, the rental income tax withholding and filing requirements need to be dealt with. Then another thing is, let's say, reporting the fair market value when you leave Canada. So there's a few different things that need to be discussed related to your property. And then
Hmm.
moving forward, if someone reaches out to me, I always have an initial call to go over the process so they understand the process exactly,
Of
so they
course,
can leave it up to the experts to handle it, because it can be convoluted with different departments, different payments, different tax withholdings, and also there's different ways to reduce the amount of tax you can pay up front. So it's very, very little. And my firm assists with that as well. So
of
we can
course.
definitely help with all that.
Wow, got it. So what happens if a non-resident of Canada wants to sell the property while they're abroad? For example, they found a really cool pl a place in Spain. They're like, we're just gonna stay here.
Yeah.
What do they have to consider for that?
That happens often, and there's something called a certificate of compliance and non-resident tax return requirement. It sounds very scary,
Hmm.
but I'm going to break it down for you.
Please.
So, as a tax resident of Canada, when you live here and you sell property, you simply declare the sale on your tax return at the end of on the following year when you file your tax return. As a non-resident of Canada, you're required to submit a certificate of compliance application. It calculates 25% of the net capital gain. And at the same time, the lawyer is required to hold in trust 25% of the gross proceeds of sale. So, if you sell your property for $1 million, 25%, 250K is held by the lawyer. At the same time, the certificate of compliance application has to be submitted within 10 days. So your accounting team should start working on it, I would say, more than a month prior to the final
Totally. Yeah.
closing,
Yeah.
to gather all the documents and all the information related to sale and the purchase and capital improvements and things to reduce
Of
capital
course.
gain.
Hmm.
So application is submitted. The CRA starts working on the application. They should agree with our calculation of 25% of the net capital gain.
Right.
That money is paid from the monies the lawyer's holding in trust.
Hmm.
We don't want the lawyer to send the whole 25% of gross proceeds, let's say the 250K, to CRA, because it can take really, really long to get money back from the government,
Hmm.
as we all know. And so once the lawyer makes the payment of 25% of net capital gains, CRA issues the certificate, and the lawyer can release the rest of the money that
Hmm.
he's still holding on to. But two caveats. One, CRA takes minimum around 6 months to process certificates. That means that 25% is with your lawyer, minimum 6 months, in case you needed to buy another property or pay off your mortgage or whatever you need those funds
Hmm.
for. Caveat two, as per the Income Tax Act, for rental property, your lawyer can actually hold in trust 50% of gross proceeds of sale. It doesn't often happen because it's an insane amount, and that should never be the amount of tax you should have to pay. But I have to disclose it because, sometimes there's a lawyer that can be very strict and wants to be by the book, even though they have a copy of, let's say, the application
Hmm.
showing how much tax might be payable.
Okay,
That's
got it.
part one with the certificate.
Hmm.
Then part two, the following year, you're required to submit a non-resident Canadian tax return, specific return for non-residents.
Hmm.
It's only going to report the sale of your Canadian property and selling related expenses, which will help lower the capital gain even further.
Hmm.
And then you're required to pay tax only on 50% of the capital gain.
Right.
So at that time, when CRA processes that tax return, you should get a pretty hefty refund of the money that they collected with the certificate of compliance application.
Got it. Quick note, actually. What if I'm like, making money here, living remotely? I mean, once you're a non-resident, is it like the other country is taxing you at their tax rate because you're like living there, even though all my business is being done in Canada, for example?
It depends on the situation. We really have to look into your businesses and what you still have in Canada, all these different things to
Hmm.
determine where you're a tax resident, where you should primarily pay tax. Then you might get foreign tax credits based on which
Hmm.
country you were paying tax in, but not a tax resident.
Hmm.
And then there might be an amount payable for you in Canada if our tax rates are higher.
Hmm.
So it really depends.
Of
Are you
course.
actually a tax resident? Are you a non-resident for tax purposes? And based on that, what are the required filings and steps depending on a sale or what
Hmm.
sort of income you're earning in Canada?
Interesting. Hey, what about pre-construction properties? I mean, is there anything different that expats should know compared to an actual resale property?
Yeah. So as a non-resident of Canada purchasing Canadian property, generally speaking, whether it's resale or pre-construction, they normally have to put a larger deposit, normally 35%, let's say compared to 20%, even at graduated payment structures with
Hmm.
pre-construction. Now, let's say a non-resident of Canada has purchased pre-construction. Now, when it comes time to closing, it's considered a commercial transaction because you're purchasing a pre-construction from a builder. Now, whether you're a non-resident of Canada, that's a landlord slash investor, or you're a Canadian resident who's an investor, when it comes to pre-construction, there's two different types of GST, HST rebates available at closing. Now, if you're living in the property as a principal residence, when you're a tax resident of Canada, the builder normally applies for the GST, HST rebate on your behalf and builds that tax rebate and the tax price into the purchase price. But if you're an investor, you're going to have to pay tax at closing. And then afterwards, you will be eligible when you have a tenant in place and within 2 years, you have to file the rebate. It's called a GST HST new residential rental property rebate, specifically meant for landlords and investors. The rebate amounts are the same. It's just that the CRA wants to make sure the correct type of rebate is filed, whether it's for principal residents or whether it's for investors. So
Hmm.
that's something that's really important. And then also, often, whether you're an investor or you're a non-resident, there can be a trend or people see an opportunity to flip a home and make money on flipping pre-construction, meaning you sell the contract, your purchase contract before it's actually built because there's been some gain in the value over the, let's say, past few years. When someone assigns property, there's a lot of tax considerations that come into play, and CR is really cracking down on flippers. So when
Hmm.
you're a non-resident, technically, if you're assigning a property, you should be submitting a certificate of compliance application as well. And it likely wouldn't be seen as a capital gain. It would be seen as business income, meaning you'd end up paying a lot more tax on the sale. So personally, as our tax firm and also as a real estate broker, I don't often recommend people flipping assignments because they
Hmm.
usually end up losing a lot more on tax in the process and the items involved.
Makes perfect sense. Ruby,
Mm-hmm.
short but sweet. This has been awesome. Any last notes that you think our expat and nomad friends should know about?
Yeah, absolutely. When someone leaves Canada, Canada always is still home at heart, and you want to
Hmm.
keep an eye on what's happening at home and your potential investments because maybe you'll return in the future. Maybe you
Hmm.
want to
Of course.
buy property and give it to your kids, etc. I would say tax is really, really important. It's important you're on the right side with tax, that you properly exit the Canadian tax system, that you adhere to the
Hmm.
tax withholding and filing requirements because there can be very hefty penalties and
Hmm.
issues down the road. So I understand that when you're far away from Canada, nobody wants to talk about Canadian tax, nobody wants to deal
Mm,
with tax, and it seems like very overwhelming. But we're here to help, and I'm always happy to educate and set up a call and help our Canadians all across the world.
of
And
course.
yeah, I look forward to meeting everyone, and we do a lot of events globally. So hopefully we'll be near one of you guys and see you guys in
Yeah,
person.
that's super exciting. Ruby, you've been awesome. Really appreciate your time.
Thank you so much, Paul.
Of
Thank you.
course. Take care.
Bye.